later on after the panel session. Kindly direct your questions to the panelists in the chat box. All right, so at this point, you allow me to introduce our amazing panelists who will provide specific details about different sectors and companies we should consider in our portfolios. First on the list, we have Gloria Fadipe. She is a seasoned investment and research professional with over 15 years of experience delivering strategic insights to both institutional and retail investors. She currently serves as head of research here at TSL Stockbrokers. Next on the list, we have Omobola Adu. Omobola Adu serves as the lead economist here at TSL Stockbrokers. With over 6 years of experience analyzing the Nigerian and broader sub-Saharan African markets. Omobola's experience has been featured on prominent platforms such as Bloomberg, Arise News, Channels Television, Africa Report, and Business Day. He holds a PhD in economics from the prestigious Covenant University. Next, we have Segun Tumbi. Segun Tumbi is a seasoned research analyst with over 11 years of experience in the Nigerian capital markets. Segun has a strong background in investment advisory and portfolio management, having played key roles in designing, constructing, and reconstructing investment portfolios for diverse clients. The last on the list, we have Mustafa Umaru. He is an equity research analyst here at TSL, specializing in the telecommunications and industrial sectors. Mustafa's analytical work has earned strong Bloomberg EMEA's analyst rankings, where he is recognized as a top-ranked analyst across multiple stocks under his coverage. And his expertise has been featured on prominent platforms such as Bloomberg, Arise News, Premium Times, Tech Cabal, and Business Day. So, but before we proceed to the panel session, I'll be calling on Mrs. Gloria Fadipe to give us a summary of the outlook. Mrs. Gloria, you have the floor.
Thank you very much, Deborah. So I'll be running you through a very brief summary of our outlook for 2026, which I would say is broadly positive. So we have written this outlook in 3 sections. We have the macro section, the socio-political environment of business, and the equity and fixed income section. So just to look broadly at our expectations on the macroeconomic front, we're expecting global growth to moderate slightly in 2026, on the global scene. The IMF is forecasting around 3.1% compared with 3.2% in 2025. Regionally, we think growth will likely remain uneven, but the overall direction will be shaped by, US performance. The commodities market, we are expecting crude oil prices to soften a little this year to around $58 per barrel. In terms of current accounts, we think that we'll still maintain a surplus this year, but we think that should be lower than what we achieved in 2025. We're projecting the current account at 3.4% of GDP in 2026, down from about 5.1% in 2025, as we expect softer oil prices and higher domestic crude demand to temper exports. While we expect imports to rise, mainly from non-oil, we also anticipate a decline in oil imports due to higher domestic refinery. However, the primary risk to the current account is the performance of crude oil prices and oil production. In a case where oil prices fall below $55 per barrel and export volumes go below 1.2 million barrels per barrel, then the surplus in the current account could narrow to just about 1% of GDP. In terms of exchange rates, when we look at the statistical computations, our blended currency model suggests that the Naira could average about 1,623 per US dollar in 2026. However, we believe that a lot of factors that supported last year's performance will likely persist over the next 6 to 12 months. So these factors include, of course, a positive current account, foreign reserves, growing foreign reserves, and growing confidence in Nigeria's ability to rejoin major global indices this year, which could all boost FX liquidity and support CBN market intervention. So considering this, we believe that we'll likely see the Naira averaging about 1,500 to the US dollars in 2026, compared with about 1,518 in 2025. However, downside risk always exists because oil price is an extraneous factor that nobody can completely speak about. So weaker export earnings stemming from unfavorable oil prices could limit accretion to external reserves and put pressure on the FX markets. Generally, for GDP growth, we think favorable macroeconomic environment will support upward trajectory. We think growth will improve due to, like I said, the favorable macroeconomic environment. From an expenditure viewpoint, the disinflation we have been seeing and expectations of a dovish policy stand should support a recovery in household consumption. We also anticipate expansion in all export sector, supported by services and agriculture, which together account for about 80% of total GDP. The oil sector should also support growth, though at a lower pace, reflecting expectations of just a moderate increase in production to about 1.7 million barrels per day from 1.64 million barrels in 2025. For inflation, we expect inflation will continue moderating in 2026. We expect it to average around 14 to 15%, down from the 5-year peak of 33.2% in 2024 and 23% in 2025. However, we see some upside risk to inflation, flooding and security issues in key food producing regions could actually pressure food prices and also pressure food inflation. Thinking about that, we expect the MPC to take a measured approach. We expect a cumulative 300 basis rate cuts this year, likely to begin from the May meeting. In terms of fiscal deficits, we believe that the fiscal deficit will likely widen. While non-oil revenues are anticipated to improve due to incremental gains from reforms, but we think that will be likely improved to around 1 to 2% of GDP, while the authorities are expecting the projections as high as 4.2% of GDP. We also expect election-related slippages through higher capital spending. Accordingly, we think total debt will rise to around 167 trillion. However, compared to GDP, because of the revision to GDP base, we think that the debt ratio will likely ease to around 33% of GDP from an estimated 35.8% in 2025. On the political front, we still maintain that unless the political landscape changes significantly, which is possible because things change very fast. But as we speak, we think the APC is likely to retain power in 2026, and because they still retain the strongest footprint in the Northwest, the Northeast, and several Southwest states. And we've seen a number of defections that are strengthening their positions in other regions. In terms of fixed income, we know there are several factors shaping our outlook for the yield curve positioning. Since we do not expect a rate cut until May, it means that there's unlikely to be any significant departure from the current interest rate levels over the next few months. So we think that there's a case for investors to lock in attractive returns at the front end of the curve. However, investors should also consider withholding tax and capital gains tax, the impact of those taxes on after-tax returns. Given our overall outlook that yields should eventually moderate due to a softer policy environment, we recommend that investors can position at the term segment of the yield curve, which could offer the most compelling risk-reward trade-off, especially for tax-sensitive investors. For We are also, for the equities market, for the Eurobond market, we also remain constructive on the Nigerian Eurobond market. Eurobond market performed strongly last year as yields moderated across the curve, with the short end down by an average of about 298 bips to 5.8%, while the mid and long end dipped by around 290 bips and 217 bips respectively to 6.7 and 8.1%. Despite recent sell-offs induced by some geopolitical tensions, market conditions remain favorable. Market performance was largely underpinned by policy easing in advanced economies, which boosted offshore investor appetite for emerging market access alongside favorable sovereign current credit rating actions. So domestically, relative exchange rate stability underpinned by CBN's reforms, further strengthened investor confidence in the economy and by extension supported the Eurobond market. So we think that we still expect we're still quite constructive in that market. For the equities market, we saw a very bullish performance last year. The market delivered about 51.2%. For this year, we're forecasting growth of about 31.4% as our base case. We expect a number of factors to support growth in the equities market this year. Sustained stability in the local currency and expectation of improved foreign currency inflows into the country. Strong corporate earnings releases and strategic corporate actions should also bolster market confidence. We also expect that with expectations of monetary policy easing in 2026, they should support some allocation of assets into the equity market. We also expect that, with the successful completion of bank and insurance sector capital raises, we'll have more resilient and bigger banks, and growth should also support increases in expectations from the capital market. We also expect introduction of some large cap stocks on the domestic bourse, and this should create transactions that should be positive for the equities market. Generally, we are positive on a number of sectors. We're positive on telecommunication sector, sustained rebound in mobile subscriptions, ongoing tariff adjustments, accelerated 4G and 5G network expansion amidst rising smartphone penetration should support growth within that sector. We're also positive on the consumer goods sector, as we see room for operators for producers to increase prices to support margins. We also expect the disinflationary trend to support to lead to a slight increase in sales volume. Less volatile foreign exchange environment should also support players within this sector. For the financial services, we think that valuations are pretty much low. We expect the environment to remain the interest rate environment to remain relatively high, which should be supportive for banks' earnings. We also expect that increased capital base will support growth and, of course, act as a buffer against shocks like bad asset quality. So we are positive on the financial services sector. We're also positive on the industrial goods sector and the agricultural sector. Overall, we have buy recommendations on a number of stocks. We have buy recommendations on Cadbury, Nestle, UACN, Unilever, Danksem, WAPCO, Airtel, MTN, Access, GT, UBA, and Zenith. And that will be all for me. Thank you.
Thank you very much, Gloria, for this very, very insightful summary. It was very, very insightful and well done. So at this point, we will be moving into the panel session. And then we'll be asking the panelists some questions. And we expect some really, really insightful answers from them. So my first question, again, goes to Gloria Fadipe. And this focuses on the overall market direction for the banking sector strategy and valuation, right? So Gloria, the report highlights that the Nigerian market is trading at a PE of 6.5 times, which is a massive discount compared to peers like South Africa and frontier markets. For a client sitting on cash today, Is this a genuine buy the deep value opportunity, or is it a value trap where prices are low for a good reason?
Okay, so thank you for that question, Deborah. So yes, the valuation discount is quite striking at around 6.5 times earnings. Current valuations, though, reflect a high degree of pessimism for investors. I mean, the discount exists for real reasons. We can't deny that fact. We've had FX volatility issues, policy uncertainty, inflation, and capital controls. They have, I mean, historically impaired returns and repatriation. So, I mean, it's obvious that investors are pricing in some of this risk and expecting a high premium. So I would frame the question in a different way. I would say I wouldn't use the blanket buy the dip, and I'll see it more as a selective value opportunity. So stock selection matters and is important. So it's uh, the market appears discounted, but investors should focus on companies with strong balance sheet, pricing power, and ability to withstand any future FX shocks, rather than just looking at it as an entire broad market opportunity. So we would expect re-rating in many of these stocks because yes, many of them are genuinely undervalued and should be bought at these deep prices. But like I said, it's not a broad-based buy the deep market yet. I think investors should focus on and be selective on stocks that have strong fundamentals and are able to withstand future shocks. That's what I'll say.
Okay, thank you very much. So what I get from this is that even though most stocks are undervalued, investors should still also focus on companies with a strong balance sheet. They shouldn't just buy whatever stocks. They have to selection matters basically.
Matters.
So that's a really insightful one. So we will be moving on to the next question, and this question is for Omobola Adu. Okay, and it focuses on inflation versus real return. So while we expect inflation to moderate, it seems high. How can a conservative investor construct a portfolio that actually beats inflation in 2026 without taking on excessive equity risk?
Yes, thank you for that important question. I think the most important thing to have in mind is that there's the expectation that inflation should come down this year. Based on our estimates, we think it could probably average between 14 to 15% this year, a marked deceleration from the 20% levels that we saw for last year. Now, to put that into context from a portfolio perspective is then seeing where should you be positioning. With inflation coming down, we expect that on the equity side of things, retail institutional investors will have investors especially would have more, discretionary income to allocate more to investment activities. So it also supports the case where we're broadly positive on the equity sector. So in terms of the telecoms, consumers, banking, as the other panelists would mention today, those sectors are positioned for growth this year, and that's where we believe that investors should be putting money aside to take advantage of the optimism in the equity market. Moving away from equities, we know that it would be a good thing to have a somewhat balanced portfolio where you're allocating a bit of funds to the fixed income market just to protect against some downside risks. We're still positive on the fixed income market, especially around the middle of the fixed income curve, where we see the most positive total return impact compared to the rest of the yield curve.
Okay, thank you very much. So investors should have a balanced portfolio where they shouldn't focus just on equities, just on stocks. They should also focus on some other fixed income investments. That was a nice one. So we'll be asking Segun Tumbi. The next question goes to Segun Tumbi on pricing and volume. So this question is two in one. It's going to be on pricing versus volume and on FX exposure. Okay, so the report notes that revenue growth has been largely driven by price adjustments rather than volume. With consumer wallets still under pressure, with consumer wallets still under pressure, have we reached a pricing ceiling where further price hikes will start to destroy demand and hurt volumes in 2026? And then on FX exposure, companies like Nestle and Unilever seem to be recovering from massive FX losses of 2024. Can we confidently tell clients that the worst of the FX-induced losses are over from the FMCG sector, or does significant risk remain on their balance sheets?
All right, thank you very much, Deborah. Basically, taking off from the very first question, which speaks to the pricing volume play, right? Much of what we saw last year for most of the guys in the consumer goods space was them playing more of a pricing strategy to keep top line afloat. We would recall basically from prior years, 2-3 years down the line, challenges around FX losses and how that had skewed sentiment, given the fact that majority had booked losses and that had affected bottom line significantly. So part of the play that most of the consumer good companies had to come up with was to hike up pricing to ensure that margins, stayed relatively afloat. Now, heading into 2026, with the positives that the pricing strategy had given to them on one hand, what do we exactly see them do further come 2026? Just taking it off what the prior discussant had mentioned, for 2026, we're expecting some level of disinflationary trend, and which we expect naturally would allow for that shift, right, of increased spend on discretionary spend from consumers. That on one side should be able to at least give a slight edge of increase to volume to most of these guys. That's not discounting the fact that yes, with terms of pricing, most of these guys also still have that room, right, to increase pricing slightly. So for 2026, we should be seeing a combination of both a pricing play as well as a volume play. Volume based off the fact that we're expecting inflation to keep a downward trend in 2026. That should, at least, albeit marginal, help consumers improve on their purchases in 2026, as well as the general expectation around pricing and being able to just notch that up by some few naira, just to ensure that top line is still secured for most of these players. Then coming back off to FX exposure, like I had rightly mentioned earlier on, 2-3 years down the line, the spike in volatility of the naira against the dollar, right, and the devaluation that we saw in prior years was in part largely responsible for the losses that most of these guys had to incur. Bottom line, it affected costs for most that had imported goods as a key raw material for their operation. It affected financing for most that had FX denominated obligations, right, to keep track on. So come 2026, into 2025, 2026, we have seen significant recovery for most of these guys, given the fact that in the period we've seen, in fact, we've seen an appreciation in quote of the naira from those levels that we saw 2024 levels. We've seen an appreciation of the naira. And heading into 2026, we're expecting relatively to see that stability that had come to play in 2025 still subsist into 2026. So on the part of FX, we can stand to say that the worst years has come to pass, and for most of those guys is now being able to sustain operational efficiency, which they had put forward in 2025, and we have seen the resultant effect of that on their books to sustain that into 2026 and to just ride the benefits that are come all through 2025 into 2026. I hope that answers that.
Yes, that really answers that. That was a very elaborate answer, and we would like to move on to the next question, which is directed to Mustafa Umaru on cement pricing. Cement revenue growth has been driven almost entirely by aggressive price hikes rather than volume growth. With the report forecasting further price increase in 2026, is there a risk of government intervention or demand collapse that investors should be worried about?
Okay, thank you very much. Thank you very much, Deborah, for the question. So let's just put some context on it. 2024, we saw a 57% price hike. In 2025, as at 9 months 2025, we've seen a 34% year-on-year price hike. And our forecast for 2026 is a 25% year-on-year price hike. So what that trend tells us is, while we see price increasing, is increasing on a moderate level. And that's in line with our forecast that inflation is decelerating. And we've always said that prices reflect macroeconomic realities for the cement players. And as long as we see an elevated inflationary environment, we would actually see that play out in prices. But as our in-house forecast has alluded to, we continue to say that inflation is decelerating, and we are seeing that in our forecast for prices. That said, we expect that prices will continue to drive top line for cement players in 2026, largely due to the fact that we are seeing a moderate rise in volumes. Volumes are increased as of 9 months 2025 at 2.74%, largely due to the fact that we had seen that the private sector has been constrained largely due to the macroeconomic realities that had affected the sector for 2024 and 2025. So that said, while we expect that prices will continue to grow, though at a softer level, we believe that it will continue to be the main driver of top line for cement players. On government intervention, no, we do not foresee a significant intervention by the government. We had seen that try to play out in 2024, but we did not see it hold any sort of water, largely due to the fact that the cement players is largely a seller's market, and the cement players will decide on how much they sell. And we haven't been able to see in recent years government have hold any weight in trying to regulate prices along the cement lines. On demand, we do not expect to see a sharp collapse in demand for cement players. We continue to highlight the infrastructure deficit that Nigeria currently holds. And we expect that the private sector will continue to rise up to try to fill up the deficit that Nigeria currently has around the infrastructural space. So we do not expect to see a significant decline in demand. We expect that demand will remain resolute. That said, we highlight that downside risks to our forecast is prevalent, largely due to the fact that it's a pre-election year, and the government might remain distracted by the electionary activities that usually occur around this year. But we expect the private sector to pick up in 2026. Thank you.
Thank you very much. So what we get from this is there's little or no risk of a government intervention on or even a demand collapse from investors, and then also that the inflation is decelerating, and everything is looking up, and this sector, the private sector, should also do better this year. So the next question, we'll be circling back to Gloria Fadipe, and is on asset quality and dividends. We've seen impairment rise as banks exited the forbearance regime. Yet, you forecast an improvement in asset quality in 2026. Does this cleaner balance sheet translate directly into higher dividend payouts? or for investors in 2026, or will banks conserve cash to meet new capital requirements?
Okay, thank you once again, Deborah. I think, like I always say, this is not broad-based, so let's just look at it. Asset quality has improved for many banks. A lot of banks have exited the forbearance regime. It's a positive, but I do not think it necessarily automatically translates into materially higher dividend payout ratios. One, there has been a near-term spike in impairments for many banks. Also, banks are operating in a more demanding capital environment. They have higher risk weights. There's a lot of ongoing regulatory stifling going on. So banks will also, in as much as we think that they should begin to reward shareholders, we think that they will also have their eyes on preserving capital and capital conservation. So many banks would also like to retain capital, at least to be able to face future FX-related shocks and any shocks that may come around, especially amidst the tight regulatory environment. So we think the dividend outcome will be differentiated. So expectations from banks will be different. Well-capitalized banks with strong internal capital generation may have room to increase payouts, but we do not think it is something that we expect from the entire players in the sector as a whole. So we've been seeing some signals that banks will likely pay more, which for the fact that earnings have been strong and they are entering into 2026 with cleaner balance sheets and able to withstand. We expect that impairment charges will be relatively lower in 2026, which should give room for more profits for the banks. However, like I said, many banks will largely still prioritize capital retention so as to be able to create sufficient buffers against any future shocks or any future regulatory requirements. We should also note that for holding companies, there's also a restriction on payment of dividend if the holding company capital does not exceed the capital of all of the subsidiaries. So for banks that operate as holding companies, that requirement will need to be met before they can even pay dividend. So to look at it on a case-by-case basis. A few banks have pointed towards increased payouts in 2026, but like I said, it may likely not be broad-based, especially as many banks will still be thinking of conserving capital.
Thank you very much. Before we continue with the questions, I'd like to remind us that there'll be a question and answer session just immediately after this panel session. And if you have any questions whatever questions you have for our panelists, please drop them in the chat box. And then after this session, we'll be focusing on answering those questions for you. Okay, so let us continue with a question for Omobola Adu on FX stability. The report cites sustained clarity and transparency in the FX market as a key driver for foreign portfolio inflows. From a macro perspective, how fragile is the current stability? And should clients with USD obligations continue to hedge, or is it the worst of the volatility? Is the worst of the volatility behind us?
Yeah, thank you for that question. So I think it's important to, let's say, contextualize what we've seen for the Naira, at least for last year. So as we all know, for last year, the Naira appreciated to end the year averaging around 1,015, 13 Naira to the US dollar. In terms of the key drivers for that, we know that the current accounts remained in a was expected to remain in a surplus for last year, basically driven by increased remittance inflows. Also, we saw stronger exports, and in terms of the trade balance, closing in a positive. For this year, we think that the current account is expected to remain in a surplus, although it's going to be much lower compared to last year. So in terms of trade balance, we expect that to continue to remain positive, although we might see just a little bit of moderation on the back of expectations that crude oil prices are expected to be softer this year. And then in terms of the exchange rate, it just to highlight, we think there are two additional, one key driver that we expect to happen this year, which if that crystallizes, it means that the exchange rate could see more gains in terms of appreciation. And that's the fact that we expect Nigeria to rejoin some of those key emerging market indices this year, especially on the fixed income and equity side. So on the fixed income side, we know that Nigeria exited the JP Morgan's Emerging Bond Index about over 10 years ago, around 2015. And as at the time Nigeria was in that index, about close to 3 billion was invested in the fixed income market. So it just gives you the sense of indication that if Nigeria rejoins that index this year, which by expectation is more likely to happen maybe towards the second half of the year or June at the earliest, we could see quantum of inflows to that magnitude coming into the market. Over the last couple of weeks, we've seen foreign investors already positioning ahead of that eventual rejoining of Nigeria into that key fixed income market. The equity market is not left alone. We know that Nigeria was removed from the Morgan Stanley index, and there are also conversations that have been happening over the past 18 months for Nigeria to rejoin that index. We also believe that by June, we could get more clarity on when that is likely going to happen. So if those two factors crystallize, we see more room for the Naira to appreciate, probably averaging between 1,300 to 1,350 for this year. So we think in terms of depreciation pressures, I would say the worst is likely behind us. We are unlikely to return to those levels where we saw the currency depreciating to the 1.6, 1.7 levels. But that said, we still expect to see some volatility. So there are going to be periods this year where we're likely going to see the Naira experience some upside pressure. If we go back to just a couple of weeks ago, we saw pressures manifesting on the back of the tensions in the geopolitical space, the US Venezuela issue, as well as the US Iran issue. But I'll say that the worst is behind us in terms of depreciation pressures on the Naira. We expect the stability to continue to be sustained this year. Thank you.
Thank you very much. Thank you very much, Omobola, for that answer. We'll be moving on to Mustafa Umaru. This is the last question, and it is on telecoms recovery. The report calls 2025 a turning point for telecoms, with the tariff hikes finally approved. Does this tariff increase fully restore the margins for MTN and Airtel, or do they need further hikes in 2026 to remain profitable in real terms?
Thank you very much, Deborah. So, for context again, where are we coming from? We're coming from a period of elevated exchange rate. We're coming from a period of elevated inflationary environment, and all this has drove significant losses for telecoms, the telecommunication operators in 2024. 2025, it was necessary that tariffs needed to be hiked. Tariffs have not been hiked for 12 years prior to that hike, and we had decided, we had come out to say it was necessary to protect margins for telecommunication operators in 2025. And that came, we saw a 50% telco tariff hikes in 2025, and this has helped preserve the margins of telecommunication operators in 2025. That said, that's not the only thing that protected margins. It's one thing to say that spurred the recovery, but that's not the only thing that protected the margins of telecommunication operators. We saw slower growth we saw slower cost growth, and this was largely driven by our expectations of a decelerating inflationary environment. This slower cost growth, and we also saw the fact that the telcos renegotiated, especially MTN, their tower contracts. These tower contracts, especially the fact that they replaced the dollar index parts of the contract and changed that to Naira, that helps significantly save costs for telcos in 2025. Now, once we saw that tariff come up at the top line, we saw slower cost growth. That helped protect margins like the EBITDA margins. And down we saw a significantly reduced as of 9 months 2024. We saw a significantly 2025. We saw that there was literally no FX losses left, coming off the fact that we had seen almost a trillion naira in FX losses at 9 months 2024. At 2025, we're seeing FX gains. So we had seen that telcos have taken significant steps to repair their margins across all line items on the income statement. And we also saw that provide value for shareholders in 2025, with MTN declaring dividends as of 9 months 2025. So yes, I say we need other tariff in 2026? No, we are not forecasting that. We believe that apart from the tariff increase that happened in 2025, telcos have taken the necessary steps, also coupled with the fact that, like everybody has mentioned, our macroeconomic environment is improving significantly. We expect that telcos are expected to continue on an upward trajectory in 2026, and we believe that profitability is very much protected come in 2026. Thank you very much.
All right, thank you very much, Mustafa, for that, for the answer. I just want to remind everyone that we are here for you, and if you have any questions whatsoever to ask, now is the time to ask those questions. Whatever questions you have, we are here to answer those questions. So for now, we are done with the panel session, and we will be moving straight into the Q&A session. While we are waiting for more questions, we'll start with the ones that we have here. For the first question, this one goes to Omobola. As a Nigerian based abroad, how profitable or risky would it be investing in the Nigerian market, given the foreign exchange vulnerability going forward?
Yes, thank you. So, like we just discussed a few seconds or a few minutes ago, the overall theme for the exchange rate is that the currency is going to be relatively or more stable this year, with room for appreciation. Now, for a Nigerian abroad investing in the market who needs to convert back to USD, the returns are likely going to be much stronger. So take, for instance, if somebody had invested in the fixed income market at the start of the year when the currency was still around the 147 levels, holding an investment over a 1-year period could translate to a return profile of over 25% in the fixed income market on the back of the expectation that the exchange rates could appreciate to 1.350 levels alone. So there are two ways investors abroad are likely going to benefit. One is on the return profile of the asset in question, as well as benefiting from the appreciation of the currency. Now, if you take that mindset to the equity market, it means that your returns are more or less going to be magnified, because you are going to be gaining on the asset itself, as well as you are also going to be gaining in terms of converting your proceeds back to USD. So, like we mentioned, it's investing in the Nigerian market this year is going to be positive. As an investor abroad, your returns are more or less likely going to be magnified this year on the back of the appreciation pressures in the currency, especially if that is going to be sustained till the end of the year.
All right, thank you very much. We have some more questions coming in. Please keep the questions coming in. We'll do well to answer all of those questions. So the next question we're taking is, Okay. Good afternoon, panelists. I have two questions. One, we've noticed smart money movement in some sectors like oil and gas and banking sectors. Is there any level of insider information determining certain investors' positioning ahead of such movement? Secondly, what's the level of foreign investors in the market currently? Is there policies to minimize how they exit the market in is there policies to determine how they exit the market to minimize market shocks to enable local investors absorb the shock and avoid crash like what happened in 2008? Mrs. Gloria, would you like to answer this question, please?
All right, thank you, Deborah. I'm not sure I understand what he means by smart money. If that person can explain what he means by smart money. However, the second part of the question says that
Okay, secondly, what's the
yeah,
level of foreign
foreign
investors?
investors. So I think currently we're about 20%, 80 local, 20% foreign. I think about that range. And if you're saying that there should be policies to minimize how they exit the market, then you are creating problems for the market because we don't want to have a market. What we are working towards a free market where people can exit and where there's free exit and entry. So if you it's not positive for the market for us to have controls over their capital, how they move. I mean, the last time we had such controls or when we had FX liquidity issues and many of the investors could not take out their capital, we saw how that went for the market and a lot of FPIs exited the market in droves because of such, so now to positively introduce, to directly introduce controls to minimize when they leave or when they come is I think it's bad for the market generally. However, with the level of participation of FPIs we have, I don't think will market over the years has been dominated by local players, and we've seen that has helped minimize the usual shocks we see because at some point, the Nigerian capital market, the equities market was largely dominated by foreign portfolio investors. So it was like over 70% participation by FPI. So with that level of participation, if there are shocks and they leave, we actually used to see significant dip in prices. But over a few years now, we've seen that local participation has been strong and domestic participation the domestic investors have been the main drivers of the market. So even if there is any reason for FPIs to exit the market, the shock will not be as we have seen in previous years. So I think the market has been relatively stable based on this level of participation by its foreign investors.
Okay, thank you very much.
So
But there's another question.
if you could explain what you mean by smart money, and maybe I'll be able to answer that question.
Okay, so there's also another question directed to you.
To me.
It says investors are hopeful that there will likely be bonus shares for shareholders than payment of dividend in the year 2025. Investors are hopeful that there will likely be bonus shares for shareholders than payment of dividend in year 2025 annual bank performance. Is it likely to be so?
From where I sit, from my own sector where I cover, I doubt that would ever happen. Banks have raised capital. Many people are already concerned about dilution to earnings caused by that capital raise. I doubt if any banks would likely start issuing bonus shares at this time. So for my own sector, I can say capital no. But maybe perhaps for other sectors, maybe the other panelists can speak to their sectors. But for my own sector, I know that will not happen.
Okay, so this is going to be an open question. Any of the panelists can answer. Please, how do you see the REIT market in Nigeria? Are the REIT stocks currently overpriced? So
Okay,
can any panelist?
the REITs are not I think Shegun wants to say something. You can go ahead, Shegun.
All right, thank you, Gloria. For rates, basically in the Nigerian market, we've not really seen that level of activity going on in that space. I mean, REIT basically just speaks to real estate investment trusts, which by default are linked instruments to real estate structures. I mean, asset-backed structures, which the dividends or the proceeds from that investment are being distributed basically to holders of those units. We have a couple of them on the exchange, and in terms of overpricing or pricing, really, you really wouldn't be able to allude to the fact that probably it's been overpriced or still underpriced within our markets, because for every unique rate investment, it has to speak largely to the assets which that trust holds, and what exactly are the proceeds from such investments and how it's been distributed basically to shareholders or the holders of that rate. So it's not really a function of it being overpriced really, or not being overpriced. I would rather want to look at it from the aspect of how deep is that market within the Nigerian context, and is there still room for more listings of rates on the market? And yes, there are. We have just a couple of them right now, and I believe that the space, that niche within the Nigerian market itself is not yet fully tapped. There's still room for more, largely also given the fact that, I mean, in the Nigerian market, we speak of the deficit of housing. So imagine a firm coming up listing a rate and having enough housing units to back that up. You can see how scalable that market can be for anybody that's still looking into that space. So yes, it's not really a function of being overpriced or not. It's really of how deep that market is within the Nigerian context.
Thank you very much for that reply, Segun. So we move on to the next question. Is one better off timing the equity investment or buying for a long-term hold? In long-term holding, at what time can one take profits to determine profitability of the investments? Would anyone like to answer that question, please?
Okay, Deborah, yes, for I think there are many parts to that question. Should one hold long term or short term? I mean, for market returns and it all depends on the investors' plans and market outlook and expectations, and what's I mean, depends on your horizon and what you intend to do with your cash. So, but over time, we have come to realize that long-term holdings eventually yield more profitability than getting in and out of the market regularly. The other part he was asking is about what, please, if you could remind.
Okay. So he said in the long-term holding, at what time can one take profits to determine profitability of the investment?
So for every investment, you have I mean, nobody tells you when to take profits. So you have your already when you are making an investment, you have, like I said, you have your investment horizon, you have your profit expectations. And I mean, if the stock has met your process and you think you need to take your exit, why not? But like I said, the longer you hold the stock, the better the possibility of getting more returns. But if your investment objectives have been met and you think that you have met your profit expectations, I mean, there's no defined time. It's you exit when you think that you have met your horizon and your expectations.
Okay, thank you very much. I think there's time for one more question. Okay. It says, can you recommend 3 good banking stocks and 3 good company stocks that one should buy between now and March 2026 to qualify for a bonus or dividend for 2025?
Okay, so I already said I have for banks, I have buy recommendations on GT, Zenith, UBA and Access. GT and Zenith are known for, I mean, good dividend payouts, and including UBA. So you could look at GT, if you are thinking of dividends, you could look at GT, Zenith, and UBA. However, on, like I said, if there are no restrictions, we'll also think of restrictions to payment of dividend by CBN. But without restrictions, these banks have always been known to pay good dividends and give good dividend yields. When it says company stocks, does it mean other stocks apart from banks?
I think so. I think that's what he means.
Okay, so we have, like, I'll read through that again. We have buy recommendations on the likes of MTN, Airtel. So I'll just give the buy recommendations we have. We still have buy recommendations on Cadbury, Dangote, on Nestle, UACN, Unilever, MTN, Airtel, and the banks I just mentioned. And I think a number of these companies also pay relatively attractive dividends. So
Okay, thank you very much. For those asking if the session was recorded, yes, the session was recorded, and for those who want to relive the experience, also it's going to be made available on YouTube later on. So yes, you can always go back to it and listen and get every information at your fingertips. Okay, so on that note, we might not be able to take all of the questions that we have for today. But on that note, I hope that we all enjoyed our time here. We all I hope it was a good learning experience for us all and an eye-opening experience. I'd like to say on this note, we have come to the end of the session for today. Thank you for honoring our invitation. We trust that you got value for your time, and we hope that we will be valuable partners in your 2026 financial journey. Okay. Please note that CSL operates from Lagos, Abuja, Port Harcourt, and Kano. And you can also, if you have any further inquiries, you can contact us. You can contact Mustafa, or his email address is mustafa.umaru at fcmb.com. For Gloria, it's gloria.fadipe@fcmb.com. Shegun, we have shegun.tubi@fcmb.com. And for Mobola, it's omobola.adu@fcmb.com. Once again, thank you for being with us, for staying with us until this point. I would also like for us to note again that the session was recorded for our benefits. Thank you for honoring our invitation. Goodbye and have a pleasant day ahead.
Thank you. Bye, everyone.